to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Jim Brown. Jim is a partner and business valuation specialist with Perishow, Tombor, and Brown, newly renamed firm, a CPA firm here in San Jose, actually located in Campbell, aren't you? Anyway, been with the firm since May 1997. Previously, he was a regional vice president at Union Bank and Bank of the West. Jim holds an MBA from the University of California at Berkeley and a BA in Business Administration with an emphasis in finance from San Francisco State University. He's an accredited senior appraiser in business valuation, which is awarded by the American Society of Appraisers, and he's a certified financial planner. He performs valuation studies for a number of purposes that we're going to be discussing in our interview, and he also provides management and financial consulting services. So today, Jim and I will be talking about the role of the business valuation specialist. Oh, I wanted to mention something else about Jim that I found out. So you have an interest in antique cars, is that right?
I have an old car.
He has an old car that's his weekend project. So anyway, what kind of car is it, Jim?
It's a 1939 Pontiac four-door sedan.
All right. And do you actually have it running?
Not running again yet.
Okay, we'll get it there. All right. Well, anyway, so we're going to be talking about the role of business valuation specialist and sort of a new profession in some ways, although let's just say that it's been a profession that is maturing as far as refining of standards and other things, right, Jim?
It is.
Yeah. So I'm a certified public accountant, folks, in tax practice, and I've seen this business valuation area blossom out. Okay, so I started back in 1974, and really things started, I'd say, hitting the fan in the mid-'80s. And in our area in particular, because there was a gentleman named Owen Fiore that came to town who was promoting the idea of business fractionalization and taking advantage of business valuation adjustments. Some people call them discounts related to that. Anyway, now the use of a qualified appraiser is required in the tax law by the courts and even for financial reporting. So, Jim, why don't you tell us a little bit about what is a qualified appraiser and comment a little bit about some of these requirements about using an appraiser.
Sure. Well, first we need to talk about the type of property that we're appraising. And what most people are familiar with is real estate.
Right.
But there's other types of property. There's personal property, machinery and equipment, gem and jewelries, and business valuation.
Right.
So that's my area is business valuation.
Okay.
And we value a number of different types of business assets that I'll explain in a minute. And a qualified appraiser is one that's accredited by a nationally recognized appraisal accrediting organization. Mm-hmm. And it's especially important that those be a nonprofit organization. And there are several of them. The organization that I'm a member of is American Society of Appraisers. Mm-hmm. And appraisers go through an extensive educational process. In the ASA, there's 4 principles evaluation courses that are required that are 4 days long. At the end of each is a 3-hour exam. And there's also study and exams in ethical conduct and in something called Uniform Standards of Professional Appraisal Practice that's actually recognized by the U.S. Congress. And at the end, there's a requirement to submit an actual appraisal report that was done by this candidate to an international board of examiners that reads their work to see if it meets the qualifications to be accredited. And then the experience requirement is 5 years of full-time experience to get a the designation accredited senior appraiser. So it's quite extensive. There are others that aren't as extensive as that, but they're similar.
Right. Now, for CPAs, the AICPA actually has their own business valuation credential. Are you familiar with that?
I am, yes. It's called ABV, Accredited in Business Valuation.
Okay.
And there's others that are similar.
And it's a similar sort of qualification, though, isn't it? As far as I know, that you have to do a valuation report and that it's evaluated and so forth.
It's similar. It's less extensive than the ASA, but it is similar.
Okay. Okay. All right. So maybe again you could comment a little bit on these requirements as far as some of the situations where an appraiser is actually required, and maybe particularly in the tax area. And so
sure. In the tax area, most people think of appraisals. What we're appraising is usually it's a private business or a percentage of a private business.
Mm-hmm.
If it was stock in Cisco that we're talking about, it's easy because we can go online and find out what its value is. But if it's a private business and it hasn't been sold, then we need an estimate of what its market value might be. Mm-hmm. So if someone sold stock in a private company, there may be a capital gain to report. And the question is, what's the quantification? How much is that? So a professional appraiser has the qualifications to actually estimate that value that the IRS would accept. Mm-hmm. Same thing if someone passes away. If they die and they owned an interest in a business or the entirety of a private business, that needs to be appraised to decide whether or not its value is high enough to be included in their estate for estate tax purposes. Mm-hmm. Also, what people do is they give away shares in companies instead of waiting until they die to transfer it, say, to the next generation. So there's a requirement for a qualified appraisal for that as well. So those are tax-oriented reasons.
Yeah. Now, one big one, that in the area that I work in a lot, as you know, is I work in the area of helping people with employee stock options. And so this has become, let's just say, huge in the last several years, sort of as an aftermath with some of the business collapses that happened not so long ago, and the scandals with WorldCom and so forth. So, and it's kind of ironic because these were public companies, but they ended up having a big effect on private companies too, because there became much more regulation related to how employee stock options are used and valued, and requirements for valuation. So before, I'm trying to remember when all this came in. It was, I guess, in like 2005 or so. So before then, it was sort of loosey-goosey. It was like, the board of directors could just sort of, by edict, say, okay, well, here's what the value is. And suddenly, you were required to have some basis for the valuations that you were using for the values of stock that was being issued, and also for the stock options for financial reporting. And so then we get people like you involved in this. So I create, I'm sure, an enormous amount of business for you.
It does, and that beforehand, when companies issued stock options, if they issue the option with an exercise price that's lower than the value of the stock on the date of grant, then there's income to report.
Right.
And that's usually a very bad outcome.
Yes.
So, especially because it's a private company, it's not as if you can sell the stock then to get the cash to pay the taxes on it. So what the issuer wants to do is to set the exercise price equal to the value of the stock on the date of grant, which raises the question, what then is the value of the stock?
Right.
And there used to be a rule of thumb that boards of directors use called the 10-to-1 rule in early stage tech companies. So the idea was if the last round of financing sold preferred stock at $2 per share, then the common must be worth 10% of that, which is 20 cents. And the IRS decided they didn't want to accept just a rule of thumb. They wanted someone to actually do some economic analysis on that to see what it was really worth.
Yeah. How fun. Okay, well, anyway, so it's a different world, and suddenly business valuation specialists are critically important, and that's part of the reason why we're talking about them today. So let's talk about, again, just briefly, some areas where valuation studies are used. So you mentioned a couple of them, like estates and gifts, and we've mentioned the area of stock options. What are some other areas?
Sometimes a private company is approached by another business with the purpose of wanting to buy the company, and the owner of the business has no idea what it might be worth, so they'll engage a professional business appraisal firm to value that company, to give them a kind of a benchmark value for what it might be worth. Other times there's, say, multiple shareholders of one company or partners in a partnership, and one partner wants to leave, and the parties can't agree on what the value of their ownership interest is, or they just don't have any idea how to estimate its value. So they would hire an outside appraisal firm to come in and help with that. Divorce is another one, where people divorcing where they own a family business together, they need to then split that up and estimate the value of what that business might be worth for the divorce. So,
right. So I mean, what we're talking about here partly, folks, is we have different types of assets people may have. So one person may want to have, let's say, one person wants to have the house, their home, and the other person wants to get the stock, or may want to have the stock of this business. So, okay, so how do these match up in value? And then, is there going to be some cash or something else to settle up differences and so forth when you're sort of trying to come up to some sort of an equal division of the property? All right, well, and how about financial reporting? Maybe you can talk a little bit about what's been going on in that area.
For preparing financial statements, historically, accountants prepared financial statements based on historical cost. And the International Accounting Standards Board and the Financial Accounting Standards Board here in the U.S. several years ago decided that that wasn't relevant enough to the value of these assets today. So they began writing rules for all the accountants that I'm sure you're well aware of, requiring them to write financial statements at so-called fair value, which is essentially fair market value. It's not exactly the same, but it's very similar to it. So that's created a need then to value assets of businesses for a number of different reasons, and valuing intangible assets like patents, trademarks, trade names, in-process research and development, customer relationship lists, a number of things like that that are all intangible, non-competition agreements. So it's opened up a whole new world of valuing assets that were never paid much attention before.
Right. Wow. So, wow, it's just a great time to be a business valuation specialist. Okay. Maybe you can tell us a little bit what the process for conducting a business valuation study is.
Sure. A lot of it depends on what the asset is that we're appraising, but typically there's three approaches to valuing. Usually it's a business. Let's take a business as an example.
All right.
Then we can look at the balance sheet that lists the assets and the liabilities, and the difference between the two is the owner's equity. And if we take those assets and write them up or down, and the liabilities up or down to market value, maybe that's the value of the company. But that isn't always the case, because it misses another asset there might be there that you can't see and isn't listed, and it's called goodwill value. And goodwill value is based on the earnings of the business, not just its physical assets. So the asset approach is one method. A market approach is another one. And in the market approach, we would look at a database of private sale transactions where companies in a similar line of business and of a similar size have actually sold in the past. And we can compare their sales price two attributes about the business, like its sales, its earnings before tax, its earnings after tax, a number of different elements, and create a ratio of the price divided by the earnings. That's the famous price-earnings ratio that people hear about.
Mm-hmm.
So if we have a basket of transactions and there's kind of a central tendency of what that typical price-earnings ratio might have been, for these businesses, and the subject company that we're appraising is similar, maybe we could use that same ratio and apply it to this company. Another method within the market approach is using public companies. We have very good data about the value of public companies from stock market information daily.
Mm-hmm.
They're huge compared to a small company, so
Yeah.
appraisers have methods, analytical methods, of adjusting the multiples of a public company to a private company, they're lower,
Mm-hmm.
to apply them. So now we've considered an asset approach and a market approach, two methods inside the market approach, and the next is an income approach. We look at the earnings of the business and assume a rate of return that the investor would like to earn and use a mathematical process called either discounting or capitalizing and estimate its value based on its earnings, and more importantly, its expected future earnings. It's common to look at maybe historical financial statements of a business and average them, but the real question is the average of those last several years going to be representative of what a buyer would get if they bought the business?
Mm-hmm.
Because the buyer gets the earnings that are coming, not those that have already been.
Right.
So we look at a consideration of what the forecast for the earnings might be. So there's three approaches that we apply in almost every case, and then at the end we weight those outcomes from each of those methods according to the quality and the quantity of the information that we were able to obtain.
Okay. So, well, sometimes we have people that are involved in buying and selling businesses, or helping people in buying and selling businesses, maybe I should say, business brokers. So, a little bit like a real estate broker, only they're, instead of helping buying and selling properties, they're helping people buying and selling businesses. And they have developed, ways that they also do some business valuation. Can you tell us a little bit about the difference between an approach that might be used by a business broker as compared to what might be used by a business valuation specialist?
Yes, the difference between a business broker and an independent valuation specialist is that the word independent. A valuation specialist doesn't take sides in a transaction. It's unethical to do that.
Mm-hmm.
So whether we're working for the buyer or the seller doesn't make any difference. They get the same value. But a broker's job is to maximize the value for the seller. And if there might be a buyer who has some reason to pay more than a typical market player might pay, then they'd like to sell it to him to maximize the value. So the motivation of the seller and the broker are together. The more, and usually brokers work on commission, so the higher the value of the company at which it's sold, the more commission the broker makes. It's unethical for an appraiser to work on a commission basis.
Mm-hmm. Mm-hmm.
So we do work for companies and helping them with a sale transaction, but it's not our primary line of business. And the broker's job is to try to identify that one company who will pay maximum value, and sometimes they put the company up for sale with the intent of starting an auction. Let's identify potential buyers and ask 4 or 5 of them to make a bid on this company, and of course they tell each of these potential buyers about the others so that they'll raise the price and try to outbid each other.
Okay. So that sort of leads to another one of the questions, and that is, why are companies sometimes bought and sold for values that are widely different from an amount determined that would be based, that you develop if you did a valuation study?
The word synergy comes into play. And what does that mean? If we take two companies and look at their values separately, and we get whatever that number comes to. But if we put the companies together, the sum of those two companies might actually produce more earnings than the sum of the two companies separated. Now, why would that be? Well, let's say each company has a warehouse and they're each, say, 40% utilized. Well, maybe if we put the two companies together, we can run that utilization percentage up to 80% with only one warehouse. So we have the same sales and mostly the same staff, but only one warehouse. Or a large company buys a small company, and let's say it's a distributor of some kind of product. The large company usually has better buying power because they can buy larger quantities and maybe rail car loads, so the shipping costs are lower. And when they buy this, call it a target company, all of a sudden they can buy for this little company at a much lower price. So the gross profit margin in the hands of this buyer is higher just by signing a paper that says, I'll buy your business. So that's one reason why someone would pay more than another would for a business. If you and I got together and bought this small company, all we have is money. We don't have another business to bring to the table where we can combine warehouses and improve buying power. So we could not afford to pay as much as this other company would. So that synergy, you see that in the public stock market, where one public company is taken over by another, and they'll pay more than the trading price of that company for small trades in the stock. And that's usually one of the reasons. They're expecting that in the hands of the buyer, the seller's company will make more profit.
So I think part of it, what it comes down to, is that a buyer rationalizes to themselves. They're hoping they're going to get these synergies that you're talking about. And sometimes some of these things, frankly, are emotional, even for large companies. Because, well, you talk about, for example, Warren Buffett, okay? Although in many ways, of course, he's very rational, but in other ways, he may be rather emotional because he buys companies rather than buying stocks. So they come up with their own reasons, if you will, about why they think that this is going to really be a bargain purchase for them, even though they may be paying more. I think a real classic, though, is that I think of banks, okay? So if you have, a regional bank, I'm trying to think of, maybe years ago, maybe a Crocker Bank, let's say, I'm just throwing out a name, but may have been pretty well a West Coast operation. And then you have another bank that's in the East Coast. I'll just throw out a name, let's say Chase Bank, okay? So Chase Bank may not have had a West Coast operation. They can buy all these locations, and the clientele or the customer base that the Crocker has already established, by just buying this bank, then they've got suddenly a market present in the West. And so in a sense, they're buying time. Because otherwise they would have to go in for each location and build the customer base and so forth. So anyway, just because we have a value and evaluation study doesn't mean that's necessarily what something's going to be sold for, I guess is what it comes down to.
No, if we really want to know the value of an asset, we should put it up for sale and sell it, because our job as independent appraisers is to estimate the value of an asset absent a transaction. So our question is, if there were a sale, what's the most likely price at which it would sell under these circumstances?
Right, and also though, it's a market value. It's not for an individual buyer.
That's
for
right.
This individual buyer, this may have a much higher. It's a little bit like the farmer, okay? he wouldn't pay that much for land in general, but for the land that's next door to his, he will pay a premium.
And we see cases like that. We're helping a farming company right now out in the valley that had an offer to sell their company to one of their largest customers. And the risk profile of this business in the hands of that large customer is much lower than it would be if you and I bought it.
Okay.
So they may be willing to pay a whole lot more money than you and I could afford to pay.
Okay, Jim, we're just about out of time. Maybe you have a final thought or a piece of wisdom to throw out as we conclude this.
Sure. I think one of the most important things I could say is that in considering value of private businesses or other intangible assets, it's important to engage the services of a qualified, accredited business appraiser. And what I would recommend is ask the appraiser about the letters behind their name and ask them to please describe what was required of them to obtain that accreditation.
Okay. Well, folks, this is just an introduction to learn a little bit of something about this. Maybe your son or daughter should be looking at this profession that's growing of business valuation specialist. It has just blossomed, as I've said, but it is a very important role that these people are playing in our community, and so I thought you should learn about it. We'll see you next time on Financial Insider Weekly.